Let's talk about the Fed, but via oil. Start with the sort of overnight moves that we've had in the markets, because waiting for the Fed, things seemed pretty calm, a lack of volatility in many asset classes. And then, I've got this chart here, 67.30 shows oil more than four times, more volatile than stocks. This is something that comes back to haunt central banks globally, the oil price. Do we have any stability here, really?
Yeah, I mean, it's been in a range for some time. If we're thinking about the long-term fluctuations in the oil price, what's been happening recently, it's not that long ago, oil was $150 a barrel or 120, and then it was down to in the 20s. So movements in the range 40 to 55 are not that great in historical context. And the price of oil is a balancing item, really, between huge concepts that don't have to fluctuate very much to make a difference to the price. The concepts being the global supply of oil and the global demand for oil. And those things, in my judgment, have not really moved very much over the last, well, certainly not over the last couple of days.
All right, Manus, jump in.
Yeah, Eric, a very good morning to you. I mean, when you talk about the supply side, obviously we've been covering OPEC, and the rhetoric from OPEC is that they've got a 6-month deal, OPEC and non-OPEC. Do you think that to rebalance the market, you're going to need to see some kind of substantial extension from OPEC and non-OPEC going forward?
I mean, there's always this conflict between OPEC suppliers of oil and non-OPEC suppliers of oil, as you rightly identify, and the shale suppliers in the US being part of that. Quite how that plays out over the coming months and indeed years, obviously is unknown. I don't know how that's going to play going forward. My hunch is that the deals struck by OPEC, which are deals about restricting the supply of oil in order to support the price, will not be stuck to. The past, if the past is any guide, they've been stuck to for periods of time, like a few months at most, and after that somebody always breaks the deal because it's in their interest to do so, and I imagine something like that will happen in future too.
Eric, as we wait for the Fed to make its decision today, courtesy of Goldman Sachs, I've got this great graphic to show you, which shows returns in various asset classes since 2008, basically. And you can see here, European high yield, S&P 500, various asset classes really doing well at a time of quantitative easing. You can make that link if you like to. On the other hand, though, US wages, consumer prices in the US and in the euro area, a little bit sluggish. You wouldn't necessarily expect them to be in the same sort of 200% inflation or wage growth, perhaps. But certainly trying to make the point that inflation has been surprisingly elusive, perhaps, despite all of the QE.
Right. So there's other factors weighing on inflation. There have been these 15, 20 years, and there still are. And those other factors are to do with globalization, to do with the role of developing economies such as China in bidding down prices globally, and those factors have pushed down on wage settlements and inflation right across the developed world for the last 15 years or so. It's possible that the new relationship with China, between the US and China, will slightly change that game going forwards, maybe slightly. But you're right to identify the impact that QE has had and very ultra-low interest rates has had on asset prices. The nostrum bit of economics for you. You can't change anything real by changing something nominal, not in the long run, only in the short run can you do that. What do I mean by that? I mean, if you change the interest rate and the prevailing, the stock of liquidity that's out there through QE, you can have effects on the way the prices of things, such as asset prices and equity prices and bond prices and all the rest of it. Can you change real outcomes like the real economy in the long run by doing that? No, you can't. And that's the disconnect that you're seeing between the asset price movements and...
Interesting thoughts. Manus?
Yeah, Eric, I mean, Goldman Sachs are actually writing a note on that this morning on the Bloomberg terminal. They're talking about the efficacy of QE. If you look at the size of these balance sheets, Japan, the US and the ECB, 17.5% of GDP. But have a look at the longer-term chart that we have for you on 10-year government bond yields, because the last two hikes that we had from the Fed, which was December 2015 and in December just gone, those were the peak moments in terms of yields. So I'm just sort of wondering, are we fully priced for 3 hikes this year in terms of the bond markets? Do they offer a decent yield? Do we top out here? Do we ever make it to 3%, Eric?
So I think there's a distinction to be drawn between the US and every other developed economy. In the US, yes, I think we will make it to 3% yields within the course of the next 18 months, really. In other developed economies, no, I don't think so. I think the US is pulling away in terms of interest rates, in terms of growth, in terms of wage inflation, in terms of CPI inflation too, from every other developed economy over the course of the next couple of years. That said, I think the Fed tightening, so 3 this year and 4 next year, that's what we've got. 4 next year is ahead of what the markets are calling for at the moment. But even if it goes as far as that, 3 and then 4, we don't see the Fed funds rate rising above the prevailing inflation rate at any point within the next 2 years. So it's a negative real interest rate, short end of the curve, and negative real interest rates all the way down the curve too for the next couple of years. A very accommodative stance of monetary policy.
So very accommodative, even with 3 and then 4. That would be a
Yes.
substantial pickup from the
Indeed.
last couple of years, wouldn't it, Eric? Thank you so much.